Welcome back everyone. The market has been ripping higher and so has our portfolio. In just 3 months, we are sitting near all-time high gains in the portfolio with a value of nearly $23,000 and a return of 11% on the invested capital. That's nearly $2,000 in pure profit already, and this is just the beginning. The reason: a concentrated portfolio of high quality growth stocks. I'm talking about world-class companies like Amazon, Meta and Mastercard. These are still very early days for the portfolio. We are starting with some starter positions, but the foundation is very strong and we are building with a purpose. Zooming out in the market, what's good to see is that bullish sentiment is back. And as prices push higher, a lot of investors are starting to say that valuations are way too high right now and they think that they missed the bottom or that it's too late to buy. I completely disagree. There are still plenty of high quality growth stocks trading at attractive valuations if you know where to look, and that's exactly what we're gonna do in this video. So let's dive into 5 of my top growth stock picks to buy right now, companies that I believe will outperform not just in the short term, but also over the next 5 to 10 years. Amazon is one of my largest holdings to date, and for good reason. It's currently trading at about 15% below its all-time high, but in my view, it won't stay that way for long. This continues to be one of the highest quality growth companies in the world, and is also firing on multiple cylinders. Let's start with the business itself. So Amazon's total revenue continues to climb steadily, but the real story, in my opinion, is in the segments that matter the most, which are currently AWS and also the advertising services. AWS is Amazon's cloud business, and it's the company's most important profit driver by far. While it accounts for less than 20% of total revenue, it generates the majority of Amazon's operating income, which we can see in this chart. As you can see, the operating income is a pretty large percentage of the actual AWS revenue generated, which means it's high margin and therefore important for the whole business. What's also exciting to see is that AWS isn't just stable, it's actually growing and accelerating. So what we can see here is that revenue growth is accelerating. And if we look back at the last quarter, we can see revenue growth year over year in that specific quarter of 22%, which is quite huge. Then you've also got the advertising portion of the business, which I don't really hear many people talk about, but I think it's overlooked and quite good because it's a high margin business and it's also growing fast. So unlike retail, if we compare it to that, which is quite capital intensive, it turns Amazon's massive product search traffic into pure profit. And as brands shift more ad dollars online by the year, as we can see from the graph, Amazon becomes a bigger player by the day. With Amazon investing heavily into AI, you can see the capex costs rise a lot, which is impacting the free cash flow. I don't see this as a negative, especially if we look at the revenue growth and the revenue growth in the high margin business portions. I think Amazon is also going to be one of the big winners when it comes to AI and AI implementation, because basically Amazon can implement it in every part of their business really, from logistics to supply chain automation to personalized recommendations, voice AI with Alexa, and even fraud prevention in its financial services. I don't think this is really hype-based, but it's really practical application at massive scale. Amazon has the data, the infrastructure, and also the talent to execute. To me, Amazon remains one of the most compelling growth stocks in the world, and I believe new all-time highs are only a matter of time. Next up is Meta, one of the best performing big tech stocks over the past 18 months. The stock has absolutely ripped since the lows of 2022, and even though it's up big, I still think it has plenty of room to run. What always amazes me about Meta is that their daily active users of their apps continues to rise. So if we look back at last quarter, they reported 3.4 billion people on their apps daily. So even if it's already a dominant force in the digital advertising world between Facebook, Instagram, WhatsApp, now also they have Threads, for example, so they try to continue to innovate. They already have so many users and it continues to grow. So With that kind of reach, it's kind of insane, and it's also what makes Meta so valuable to advertisers. If we look at advertising revenue, of course, with the growth of daily active users, the advertising revenue is still scaling. What's really bullish to me to see from last quarter's numbers is that they reported a growth of 14% year over year. And most of the times, quarter one in the advertising world has the lowest ad spend, whereas quarter four has the highest by far. So I expect this to accelerate heavily as the year goes on, and we might even hit 50 billion by the end of the year. Total revenue growth is also accelerating. If we look back at last quarter, we saw reported year-over-year growth for that quarter of 27% to $42.3 billion. But what makes Meta especially exciting for the future is that it's pouring billions into AI, including their custom silicon chips, data centers, and also foundation models like Llama. They are also using AI to enhance content ranking, improve ad performance, and develop new tools for creators and businesses. So even though Meta isn't typically thought of as an AI play or AI company, it's using AI across everything it does, and the payoff is starting to show in the coming quarters and also the quarters that we've just had. From a valuation perspective, I think Meta is still really good as an investment, even though it's ran up in stock price considerably the last 1.5 to 2 years. I think it's such a great business with much more room to grow. It's cash rich, it's user dominant, and it's also AI leveraged. So I think there is huge room to expand margins and introduce new monetization methods, for example, or continue buybacks, and it still feels like a really great buy today. Next up, we've got Mastercard. This doesn't generate a ton of headlines, I know, but it's one that I like really a lot. It's one of the most consistent compounders in the market, and even today it's near all-time high prices, but I still think it's a great investment. So let's dive into the numbers. Mastercard now has over 3.3 billion cards in circulation worldwide, and that number is still trending up. That's a mind-blowing level of global scale, and it gives them unmatched leverage as commerce continues to digitize. As we can see in the graph, even last quarter, they still grew their card number by 7% year over year for the same quarter. Why I like Mastercard so much is that it has such a strong competitive moat. It has high margins and also a product that's basically embedded into the global financial system. And right now, it's quietly putting up really strong numbers. If we look at total revenue, we can see Mastercard is still posting double-digit growth year over year, with last quarter accelerating that growth to 12%. A big driver of the growth is their core payment network revenue, which still makes up the bulk of the business to today. As global spending recovers and digital payments expand, Mastercard benefits from every swipe, tap, online transaction that flows through the network. If we pull up the charts of payment network revenue, we can see this visualized. The real unlock for me for Mastercard growth in the future is their value-added services segment. This includes things like fraud prevention, data analytics, tokenization of assets, but also cybersecurity for example, banks or merchants or just consumers. And why this segment is more interesting from my perspective than the payment network revenue is that the growth here is much higher. Where we saw a 9% growth year over year in the payment network revenue, we see 14% growth year over year in the value-added services segment. Last year alone, Mastercard generated over $10 billion in free cash flow, which they then used to aggressively buy back shares or increase their dividends. They really have like a shareholder-friendly model, I would say. And it's also a big reason why Mastercard has outperformed for so long. Mastercard routinely converts over 40% of their revenue into free cash flow, and they don't really need to reinvest heavily to grow that number. If you're questioning if Mastercard is cheap or expensive today, I would say it's somewhere in the middle. The forward PE sitting in the mid-30s, which is not cheap, but it's also not really expensive. But if you take into account the quality of the business and the growth rate that they offer, they have 30% plus margins, they have strong growth, and also a capital light model which is ready to scale and innovate, I think it's still a great buy today. Next up is Netflix. Netflix is the largest position right now in my portfolio. It's the global leader in streaming entertainment, and I will show you why I'm betting heavily on this one. As we can see from the stock price chart, the market is kind of feeling the same about Netflix, the way I'm feeling. That's why we saw such a big rise after the tariff dip to new all-time highs, and it's now sitting around $1,200 per share. I still think it has lots of room to run. One of the most important KPIs that I look at for Netflix is the paid memberships at the end of every quarter. So last quarter, they reported 301 billion paid memberships worldwide, which is massive. And what's really good to see when looking at this KPI for Netflix is that after a period of slowed growth, we now see acceleration and picking up of momentum, which is signaling that there is renewed demand, or they are just delivering a better service, which I think Netflix is currently doing, aside from expanding into new markets or targeting new audiences. We can also see this translated in the total revenue chart, where they reported 10.5 billion in the latest quarter. This reflects the steady growth that they see in paid memberships. If we compare year-over-year numbers, we can see a growth number of 21%. This also displays the ability to scale internationally. I think as Netflix grows, the network effect also continues to grow. The company's ability to monetize its huge subscriber base is impressive and also a key driver of revenue growth, next to the ability to expand internationally and increase prices in key markets. Netflix is getting to a point where they have massive pricing power over their user base, and they are showing that they can do that, and I think they will do more of that in the future. And I think what's important to understand with Netflix is that the company controls content costs better over time as it scales its global platform. We can see that from the increasing operating margins and net margins, which are now sitting at 31% and 27%, which is then really important because it means that Netflix is not just growing their revenue, but it's doing so profitably. If we look at valuation metrics, Netflix is starting to trend a little bit at the expensive side with a 45 forward PE ratio, but I still think in the long term it's going to see massive growth and you will see massive outperformance of the market as well. So Netflix continues to be one of the biggest positions in the portfolio currently, and if we see a dip, I will buy more. And last but not least, we have AMD. This is the most recent addition to the portfolio. This one specifically came down so much in share price that I now think it's a really good buy. It's a powerhouse in the semiconductor space, and I think investors are putting it in the shadow of Nvidia a little bit too much. If we look at total revenue metrics, for example, we can see year-over-year growth of 23% for the last quarter to 7.4 billion. And then what's even more important to note is the growth of the data center segment, which is now contributing approximately $3.6 billion to the total revenue. And if we look at the growth rate of that segment, we see a growth rate year-over-year of 56%, which is absolutely massive. And I believe this also illustrates really well why AMD is undervalued, and it's really well positioned to benefit from the AI boom that is coming. And as time goes on, I think AMD will gain even more traction with cloud providers, AI companies, who all nowadays require this massive amount of processing power to just train and deploy AI models efficiently. This AI-driven demand is fueling AMD's growth, of course. So AMD's operating margin is currently 10% and the net margin is very close at 9%. This to me is showing healthy profitability, even though they are investing aggressively into growth. AMD currently trades at a forward PE of about 30, which is a premium that reflects the investor confidence in my opinion. But I also think it reflects the confidence that the market has a little bit more in Nvidia because the valuation there seems to be higher. They also have, of course, better numbers to show for it, but I do think AMD is heavily undervalued here. If we also look back at historical numbers, this PE number is very low. So combine that with the fact that the growth is accelerating in key segments of the business, we will see a higher share price to follow. Thanks for watching, everybody. I appreciate you a lot. If you find this breakdown helpful, make sure to hit that like button and also subscribe for more content like this in the future. I'll see you guys in the next one.